This is FRM Part I, Book 4, Valuation and Risk Management, and the chapter on the Greek letters. And this is really just an extension of what we did in the previous chapter. Let me just quickly remind you, we started with the simple option pricing model, which had 4 input variables. Then we added volatility to it, and that was the Black-Scholes-Merton option pricing model. And remember, we did some really fun stuff with the mathematics and computing the price of a call option. Now what we're going to do is we're going to ask the question, what happens when those 5 input variables change over time? Of course, this is a dynamic environment, so they're going to change. What happens when time changes? What happens when volatility changes? What happens when the risk-free rate of interest changes? What happens when the stock price changes? What happens to the price of the call option? And that's what the Greek letters are all about. So let's go ahead and look at the learning objectives here. The first 2 are really kind of unique and separate from the Greek kind of a hedging thing that we'll do later on. But what it does is it gives us an introduction to the need to hedge. So we're going to look at a covered position and a naked position, and then a strategy to pursue to manage those kinds of risks. Then we'll go ahead and get into the Greek letters, right? You can look at those learning objectives. There's a delta, there's a theta, there's a gamma, there's a vega, there's a rho, and then we're going to look at some delta neutral and gamma neutral trading strategies, hedging strategies. So let's get those first 2 learning objectives out of the way. Let me put this in the historical context from previous slide decks. Remember, a lot of times I'll say to you guys, hey, I'm Jim, I'm a financial institution. You come to me and say you want to buy an option from me. So I will go ahead and I will write that option to you. Let's go back to that example that we had in the previous chapter when we did the Black-Scholes-Merton call option price. What was that? Stock price was 100. Exercise price was 90, and I think you paid me $16.13. Let's just round to $16, right? So you pay me that $16 today. I give you a piece of paper that says you have the right but not the obligation to buy a share of stock at $90, all right? That makes perfect sense. So the question then becomes that when you exercise that option, assuming that the stock price rises, the question then becomes, when you come and knock on my door and say, hey, Jim, I want to buy this share of stock for $90, do I own that share of stock? If I do own it, that's called a covered position. If I don't own it, then it's called a naked position. And think about what happens here if I don't own it. You come and say to me, hey, Jim, I want to buy this share of stock for $90, and I don't have it. So I have to say, hold please, and I have to run to the New York Stock Exchange and buy that share of stock and come back and sell it to you. Now that's a long way to go for me to go to the New York Stock Exchange. That's why these derivative contracts are mostly settled in cash, so that we don't have to do that extra trading. So the question then becomes, what are the risks associated with that naked position? And think about it. In our example, if the stock price at expiration is, say, $110 or $120, you're going to come and knock on my door and politely say, hey, Jim, where's my $20 or $30 or whatever that intrinsic value of the option is? But if that stock price is $200 or $500 or $1,000, you're going to be pounding on my door saying, Jim, where's all my money? That's why in that picture at the bottom, look at the arrow that's red going down there. So that's my loss. That's my loss as the naked call option writer. I mean, if that price goes to 1,000 or 10,000 or even $1 million, of course, it's not going to go to $1 million. But I mean, boy, my losses are unlimited. That says unlimited there at the bottom. So how do I manage this? Well, the easiest way for me to manage this is just for me to buy the share of stock. But then, what did we say? That stock price was $100. Then I'm out $100, and maybe I don't really want to own that share of stock because I have something better to do with my $100. Well, what I can do is I can just pick up the phone and call the New York Stock Exchange or call the broker or call an investment banker and say, hey, look, if the price of this share of stock ever gets to be a certain price, like $100 or $105 or $110, or if we want to do it equal to the strike price in this case was already $90, so that wouldn't work too well. But so what's happening is I'm seeking protection, especially if this is a stock that has the potential for momentum, right? Remember, these options are short term. We know over the long term prices are going to go like this, but boy, if momentum kicks in and that price goes up and up and up, boy, let me go back to that. Let me go back to that graph. Boy, if that price is momentum and it goes up and up and up, boy, I'm out of luck as the writer of the option. So I can just say, hey, look, if the stock price ever gets above a certain price, then go ahead and buy. Then go ahead and buy that share of stock for me. Now, a lot of times what happens is that these writers of options will write the option and it will be naked, and then they'll pause and wait and see what happens to the price of the underlying stock over time. And if it's an out of the money option and it stays out of the money, well, then there's less of an incentive to hedge. But if there's potential for momentum, then there's more of an incentive. And look at the last circle point there. It's even more difficult to predict whether an option will be in or out of the money. All right, let's go ahead and get into the Greek letters. So let's start with the delta. And we did this before back in our previous Black-Scholes-Merton option pricing model chapter. What we said is the following. Remember, we had that D1, we had all those things, and I'll show you that formula here in just a second. But then we calculated D1, and we looked that number up on the Z table to get the ND1, and that, of course, is the delta of the call option. All right, and so here, just basically, look at the blue formula there in the middle. The delta of an option is simply the ratio of the change in call price to the change in the price of the underlying asset. All right, so remember, you paid me $16 for my option, right? The question then becomes, if that stock price, which was 100, right, if it goes up to 101, what happens to the price of your call option? Is the call price going to go up to $17? Or is it going to go up to $16.30 or 40 cents or whatever it is? That's what the delta will tell us. So look at my last block point there. If a delta is 0.5, a $1 increase in the underlying price will trigger a 50-cent increase in the price of a call option. You see how cool the Black-Scholes-Merton option pricing model is, because not only does it allow us to price an option, but it gives us measures of sensitivities. And we've been doing sensitivities for a long series of chapters here. Now, one of the things I found was intriguing about the chapter reading, about the source reading, is that there's a terrific example of computing and then using the delta of an option written on a non-dividend paying stock. That's why I have that highlighted in blue there. So the delta of a call option is equal to ND1, all right? But then at the end of the reading, there's a big table that lists all of the formulas that I'll show you here in this slide deck for the delta of various derivative securities, and it has the one that I have up in the top middle there in blue. And so this is for a dividend paying share of stock. That's what the Q is. The Q is the dividend yield. So it struck me as curious, as there was lots and lots of examples in the body of the text assuming non-dividend paying stock, but then they summarize it by putting in a dividend paying stock. And so just think about this. If you look at that E raised to the Q times T, so Q is a dividend yield. What are dividend yields these days? I don't know, 1% or 3%. So essentially what you're doing is you're going to calculate, if you put in like 0.04 times 1 year, that E turns out to be, I don't know, what is that, 96 or 97. So what you're doing is you're going to discount the non-dividend paying ND1. So if the ND1 is 0.5, then on a dividend paying stock it might be 0.48 or something. So it's just going to be a little bit less. So I think that distinction is probably important. So remember, dividend paying stock versus non-dividend paying stock. Let me go ahead and refer to the D1 formula there just to remind you, because this is so important. When you take the natural log of the ratio of the stock price to the strike price, you get the return on time value. And then that stuff after the plus sign, because we're plussing, right? We're adding time value to intrinsic value. Did I say time value? I think I made a mistake. Let me go back. So if you take the natural log of S over K, stock price to strike price, you get the return on intrinsic value. Yes, I misspoke a second ago. You get the return on intrinsic value, and then we're going to add the return on time value, and then we divide by some standard deviation measured over time, right? So sorry for that mistake. But that D1 is really cool. We've got the return on intrinsic value plus the return on time value. And what that does is that helps us. So think about time value and intrinsic value helps us determine what the delta of the option is. Now, of course, let me just remind you, these deltas are probabilities, so they're going to be between 0 and 1. A delta of an at-the-money option is always going to be around 0.5. That should make perfect sense. But here's the thing, that when the stock price goes up, what did I say just a second ago for the option that I wrote you? If that stock price goes to 200 or 500 or 1,000, then that delta is going to move to 1. It's going to move to 1, and both ND1 and ND2 are going to approach 1. That's why the Black-Scholes-Merton option pricing model doesn't do a very good job of pricing deep in the money options or deep out of the money options, because essentially it becomes the simple option pricing model that I showed you in that previous chapter. Oh my gosh, go ahead and feel free to say, hey Jim, thanks for going over that simple option pricing model, because it has relevance right here to those last two circle points. Now, of course, that big old table at the end of the chapter is going to have the delta of the put option with the dividend yield in there, but I call your attention down to the bottom right after that equal sign there for the delta of the put option. It's going to be ND1 minus 1. And that's for a non-dividend paying stock. All right, so it's important to distinguish again between those two. But you should be scratching your head and pausing and say, all right, Jim, if ND1 is between 0 and 1 and I subtract 1, that must mean that we're going to result in a negative number. Of course, the delta of a put option behaves pretty similar to the delta of a call option, except for the sign. So the delta of a call option is going to be between 0 and a minus 1 because when the stock price goes down, right, when you own the put option, that's good news for you, and the put option price is going to go up. And the circle points there are the same as they were in the put option, with the difference in the sign. Now the next question is, can we use this delta knowledge to help us manage the risk of owning other derivative securities like a forward contract and a futures contract? And the answer is yes. And the good news for you guys is that the delta of a forward contract is going to be about 1. The delta of a futures contract is going to be just a little bit less than 1, depending on the dividend yield. Now, the delta of a forward contract is probably going to be 1 because deltas forward contracts typically don't have tremendous secondary markets, but futures contracts do. So remember, in the futures contracts, these things are settled every day. So you have a daily futures price and you have a daily spot price. Now, whether the futures price is above or below the spot doesn't really matter, but what do we know over time? That they're going to waver together and then they're going to converge. We have to have convergence on the maturity date of the contract. But the correlation coefficient between changes in futures price and change in spot price is not going to be 1. And so the futures contract delta might be, 0.94 or 0.96 or something like that. So I think it's safe to remember that the delta of a forward and a futures contract, they're going to be about 1, and they might be a little bit less just because of the unique characteristics of those contracts and how they are traded. All right, how about this concept of delta hedging? Let's use the delta of the call option or any other kind of a derivative, but here we're talking about options. Let's use the delta of the call option to put together some type of a hedge so that we can manage risk. And here's the image that I always give my students. I do this at the graduate and undergraduate level. You can compute the standard deviation of a share of stock or a portfolio or bonds or alternative investments or derivatives. And that standard deviation is going to be, whatever that number is. Let's suppose it's this big. When we're hedging, especially when we are delta hedging, what we're doing is we're putting that standard deviation in a vise. So pretend that you're standing at your workbench and you put that standard deviation in the vise and you crank your vise and it squeezes and it squeezes. So it's squeezing. What are we doing? We're reducing that standard deviation. We're reducing the variability. Now, sometimes you can have a perfect hedge and you can get that variability down to 0. But look what I have there in bold up at the top there. So what we have to do is we have to take an offsetting long and a short position. All right, so let's go ahead and delta hedge with a stock. All right, so what we can do is we can hedge our option position by using the shares of the underlying stock. So if we buy the call option, then we can short the shares. If we write the call option, then we can buy the shares. All right, so there's just a quick example there, second block point. Suppose an investor is long one call option, and remember, one call option is written on 100 shares, and that delta is 0.6, so in multiples of 100, so that means the delta, we can say that's 60. So if we have 100 options, right, we're going to short 60 shares of stock. So there's our portfolio. There's our delta hedged portfolio by buying, by shorting 60 shares. And then of course, if we own one put option, then we would have to go long on 60 shares of the underlying stock. Let's take a more specific example here. Suppose we have a non-dividend paying stock. Price is 200. We've got a 6-month option, call option. Price is $202. The strike price is $202. So, boy, we have the right but not the obligation to buy at 202, right? And the price is 200. So that is an out of the money option. The delta is 0.5. So, boy, it's not quite at the money. So here we have a delta of 0.5. It's almost at the money. I'm not sure that's a good finance term, but it's nearly at the money. So a delta of 0.5, that's reasonable. So we have a couple of questions here. How can we use that information about the 0.5 delta to hedge today? And then secondarily, what happens if the stock price falls to the delta? All right, so note the 2 circle points there above question 1. We've got 2 scenarios. So we'll fix one scenario here on this slide, and we'll fix the other scenario on the second slide. So the first question, what action should this guy take now to make his position delta neutral? All right, so the mathematics of this is pretty simple, right? We have, we're short the call option, right? So the delta, so you do the 0.5 times the 200, that gives me a total delta of a minus 100. So that must mean that we have to buy 100 shares of stock. So we've written options on 200 shares of stock. So we have to own 100 shares of stock, and that should make perfect sense because when the stock price goes up by $1, the option price just goes up by 50 cents. So we should have half the shares of stock than our position in the option. That should make perfect sense. All right, the next question then is, what happens if the delta falls to 0 when the stock price falls to 195? All right, so now what did we do back here? We bought 100 shares of stock. So now the stock price falls to 195, so the option is even more out of the money, right? So we're probably going to need fewer shares, and so do the math there. If we take the 0.4, which is our new delta, right? The 0.4 times our 200 position, 200 shares of stock, our call option on 200 shares of stock, that delta moves to 80. So we only need 80. So to go from 100 down to 80, we need to sell 200 shares of stock, and that should again make perfect sense that since the option is out of the money, even more out of the money, and the delta is only 0.4, that must mean we need fewer shares to execute this delta hedge. Now in that first part, we hedged using the underlying asset, but you can do it by using other kinds of derivatives. So suppose that we hold a one call option position that has a delta of 5. What that means is that all we need to do is find another option that has a delta of a -5, and then the two cancel out. Now, of course, the obvious notion here is to have one call option and then have one put option that have identical deltas, right? And so those cancel out. Of course, you're not going to execute this to manage the risk of your lifetime portfolio or your retirement portfolio over hundreds of years, right? But this is available to all investors to eliminate risk over the short term. And what we're trying to do here is we're trying to manage, in general, small changes in the price of the underlying asset with this delta neutral hedge. Now let's suppose that you write bunches and bunches of options, because the writers of options, remember what they're trying to do is generate a lot of income, right? You guys paid me that $16 a couple of slides ago. Well, suppose that I want to sell options on that underlying stock that have strike prices of 95 and 85 and 105 and 125. So I get lots and lots of you to pay me all this money today, and I hope I never see you again, so that I get to keep those option premiums. Well, if my options all have different expiration dates and different strike prices, then I'm going to have different deltas for each one of those options. And the good news for you guys is it's really easy to compute the delta of the portfolio. It's just a weighted average, and we've done this multiple times. Now, make sure you interpret this. If there's if we write these options that have deltas of like 0.2 and 0.4 and 0.6 and 0.7 and 0.8, and we take that weighted average and it turns out to be, let's say, 0.45. What that 0.45 is the measure of the change in the overall position caused by a change in the price of that underlying stock, right? And so some of our option prices are going to go up by 60 or 70 or 80 cents. Some are going to go up by 20 and 10 cents, but the overall portfolio value will change by, what did I say, 45 cents. Let's get back into more of the Greek letters. So theta begins with a T, right? So that is a logical Greek letter to pick for time. So this tells us how sensitive an option price is to changes in time. Now, the interesting thing about changes in time is that it's never going to go up, right? You're not going to buy a 6-month option from me today, and then a week from now it's going to turn into a 9 or a 12-month option, right? Time gets closer and closer to the expiration date, right? So time decreases. We call this time decay. And so look at the following formula down there at the bottom. So theta is equal to the ratio of the change in call price to the change in time. And so the easy interpretation is that second circle point. So theta estimates the value lost per day if all other factors are held constant. Now that's a limiting assumption, right? In that option that I sold you for $16, what was that stock price? 100. So if we assume that that's $100 all the way through 6 months, right? And volatility, that stays the same, and the risk-free rate stays the same. I mean, those are not really good. Those are not really realistic examples. But nevertheless, theta measures how time is going to affect the value of our option. And of course, what we can do is we can use the Black-Scholes-Merton calculus to help us compute the theta of a call and the theta of a put option. Gamma then is going to measure the rate of change in an option's delta with respect to a change in the price of the underlying asset or the underlying stocks. So this goes back to that example. What did that guy say? He had a delta of 0.5, and he thought that if the price went down to by $5 a share, or whatever that was, that the delta would fall to 0.4. So that was just an estimate in that early example, but gamma is going to tell us exactly how much that delta would change. And of course, this is really important. Look at that second circle point. Options with the highest gamma are the most responsive to changes in the price of the underlying stock. And so think about this. This is really important. If you have an option that has a delta of 0.5, right, and that stock price starts going up, let's suppose it's a call option and you own that call option, and that stock price goes up. Well, as the stock price goes up, some options, that delta might change to 0.51, right? So then the next time the stock price goes up by $1, you only get at the margin another penny on top of your original 50 cents, let's say, right? But if that delta changes from 0.5 to 0.6, oh my gosh, then you're going to get another 10 cents. So do you see the subtlety that gamma adds to our, not only our understanding of riskiness and standard deviation as it applies to call option and put option pricing, but also it helps us in understanding how to manage these risks. Now, just like we had a delta neutral position, we can also have a gamma neutral position. And there is a quick formula there. So we're going to have the ratio, and there's a minus sign there, of course. It's going to be the ratio of the gamma of the existing portfolio and the gamma of the option that you can use to hedge that position. Here's a quick example here. Let's suppose that we have short option position that's delta neutral. All right, that's important to start with, has a gamma of a minus 800. And so what happens if there's a tradable option with a delta of 0.8 and a gamma of 2? Let's go ahead and use that formula. All we're going to do is take the 800 divided by the 2, right? 800, that's the gamma, and then the potential option with the gamma of 2, so that's 400. So what we're going to do is we're going to buy the 400 calls. However, that's going to increase the delta up to the 400 times the 0.8, so that gives us with 320 shares. Now remember when we started talking about this with the theta, I said suppose all those other inputs stay the same. Of course they're not going to, so the question then becomes what happens with the delta, the theta, and the gamma? How are they related? And the chapter reading has a fairly interesting discussion on how this formula is derived, but let me give you the big picture here. And so note what's happening on the left-hand side of the equal sign. We've got the risk-free rate of interest times the price of the option. So let's just take a simple example. Suppose we have the price of the option is 10 and the risk-free rate is 10%. So we take 10% of 10, that gives us $1, right? That's kind of the dollar return on your option. All right, so think about that on the left-hand side of the equal sign. Over on the right-hand side of the equal sign, we have the three Greeks, right? We have the theta, we have the delta, and we have the gamma, and those are weighted by sensitivities, right? I mean, this is just like a regression equation, and these are the sensitivities that we know that are critical from the Black-Scholes-Merton option pricing model. So we're going to weight the delta by risk-free rate and the price of the underlying stock. We're going to weight gamma by the price of the underlying stock and the standard deviation of the underlying stock, and they're going to be squared because that's second derivative, of course. And so what I want you to do is I want you to think of this formula as a measure of sensitivities to what happens on the floor of the option market. Now, Vega, of course, begins with a V. Volatility begins with a V. So what we're going to do with Vega is we're going to measure the change in the price of an option when the volatility changes. All right, so there's that good formula. We've got the change in the call price over the change in volatility. And there's some Black-Scholes-Merton stuff there at the bottom. And so what do we know? We know that when the standard deviation, when volatility increases, this is going to increase the price of the call option. And so what do investors like to do? Buyers of call options, they like to find options that have lots of Vega, so that when the stock price goes like this, and then it goes like that, then the price of that option is going to rise. Rho, of course, is an R for an interest rate, so there's the formula there. Change in the price of the call option over the change in the interest rate, and there are the Black-Scholes-Merton inputs as well, so that you can actually compute it. the first block point that I have down there at the bottom is probably pretty important here. So if we have longer term options and we compare them to shorter term options, longer term options are way more sensitive to changes in interest rates than our short term options. And this has everything to do with the time value of the option. And that's why it was so important for me to explain the difference between the return on the intrinsic value and the return on time value in that BSM model. Now here's the final question that we ask ourselves, that, you know, we're doing all this in kind of an academic setting, right? That was a textbook. There's a chapter in that textbook. I give my students these problems all the time and they can come up with these answers. And so we come up with something that says, okay, we're delta neutral or we're gamma neutral. The question then becomes, how easy is this to do? I mean, it's relatively straightforward to do it on a piece of paper, but if you're doing this every day and you're managing a portfolio, this is much more complex and it requires much more effort. I mean, notice what I have there. I have the word concentrate, okay, and then continuously and closely. And so let me just end by giving you a quick story. I take my students to exchanges, you know, all the time, so we can go visit these people, and it's a pretty fun day. But about 20 years ago, I took my students to see the Philadelphia Stock Exchange, and it was pretty exciting back then, watching some of the specialists, you know, trade, and they explained all the stuff that they were doing to us, and my students were fascinated by it. This was before this was the semester before we went to the New York Stock Exchange. But anyway, down on Market Street in Philadelphia, they have a back room where the options trading was going on. And this was very exciting. So we went back there, and I noticed they have the monitors up above, and these are the prices of the calls and the puts. And I noticed there was this one guy who was looking up at all these prices, and then he had one of these old green computers, like in one of those first movies where they ever showed computers. And it was blinking and blinking, and I kind of went over. He was looking up and looking down. I said, tell me what you're doing. And he goes, this is my proprietary option pricing model. And he said, I am constantly inputting those prices that are tradable prices right up there into my model down here so that I know exactly what the price and the delta and the gamma of these options are so that I can form my portfolio. And I remember thinking, you know, this dude was working really hard. So he was concentrating, he was continuously, he was closely, et cetera, et cetera. And I think that brings us to the end.